Hello, everybody. Brian here from quantlabs.net. This video today on Happy July 4th to all American visitors, viewers. I know there's a lot of you out there. Thanks for watching. And thanks for watching whoever else is watching that's non-American. Anyways, let's talk about volatility. One thing I've noticed now is that there's extreme volatility hitting all the classic, supposed to be low volatile assets, namely treasury, gold, maybe somewhat. It's hard to say. But I'm going to do a comparison between all the major assets across the board to show you what's happening in the markets right now and what you can and cannot do about it and what you should be looking for. So, right out of the gate, I want to talk about this bettersystemtrader.com website. They're quite good compared to uh, other ones that I've seen. This one's quite good. There's a lot of good lessons to be learned here. And one of the things I take away is just being able to take that as an idea, talk about it, and respond to it in a video. For this is very important in the world of automated trading as well. And again, if you're like me, using TradingView to make your life a lot easier and to make true money, you might want to follow along with what I do because that's what I do at quantlabsnet.com. And again, if you go under the Learn tab, you can opt in and get notified when things like these kind of videos go out. So let's talk about this. This is kind of important. So where were we? Right here. No. Right here? No. We'll get there. Uh, there we go. Too many windows open at the same time here, or tabs. Okay, um, so why conventional wisdom using VIX for market could be all wrong. Yeah, let's take a look at that. So these are the sort of things you can quickly do with um, TradingView. The nice thing with TradingView is you get access to all the data if you're willing to pay for it per month. So for instance, if I go and just put in the standard VIX, volatility, S&P here, you can see, let's go back 5 years. So you can see here we've got the extreme move of the virus in 2020, how that got driven up to 72. Let's do all. Okay, so there we go. So here we're going to include the great world of the great financial crisis of '08. So you can see there, these are your standard metrics, 91, uh, peaking at 85 for the virus, and all of these big moves here, 20. So the normal should be in around 15 to, let's say, 21. Now, let's say if I did a cross compare of, let's say, the SPY to see the impact of it, you can see here uh, there is a little impact here on the extreme level of VIX, and yes, the markets did decline. But you can see here that the VIX relative barely draws down the SPY. Here, same thing. There is impact, yes, but generally the VIX becomes like we should kind of question that as our metric globally to understand the real volatility in the markets. So, does the VIX movement really predict market moves, or is there a better way? I think just looking at that chart right there says it all. That yeah, you can for sure use a better way to measure volatility. So what's this guy? So this guy's his name's Rob Hanna that this guy was talking to. Um, so now here's saying SPX signals can be more effective than VIX signals. The best indicator for predicting short-term market movements. Practical strategies for trading VIX instruments. Okay, so apparently there is a better metric. Now the question is, what would that metric be? Okay, so let's go back here and I'll tell you what I think it is. So remember that a SPY is only good for US. Okay, because that's it's a US centric view of the global market. And yes, they say when the US gets a cold, everyone else outside the US gets sick. Kind of true because it has so much uh relevance in the global market when you look at the US dollar as a reserve currency. Obviously, that's slipping, so on and so forth. So let's put in something that I would probably say is a lot more reliable. This is the gold silver ratio. Okay. So in here, um, you can see that this is a little better than, well, let me put back up the VIX. Okay. Ouch. Let's go back. Okay. So we're adding one more at the VIX. Okay. So is there a better signal? You probably can't see this through the noise, but right here in blue, the VIX is more volatile and more extreme on the impact on the SPY in orange. Okay. So what that tells you is you really can't use the VIX as a way to measure volatility. I think it's after the fact that the VIX has lag, and as a result, it's not that good because when you look at these extreme moves, did the SPY move down as much? No. So let's throw out the VIX. So now you can look at the one I'm suggesting here, gold, silver. There's not very many um, uh, brokers that offer this as a metric on their as a broker. But once again, on TradingView, you can see that. Uh, just as an example, if I was to put in a symbol here, who are the providers of gold silver ratio? There's only two. Saxo and Oanda. Okay, so just be aware of that. You're not going to find that. You could probably do it mathematically, but again, these are the only providers that are providing this metric. Oanda and Saxo Bank. So at the end of the day, you can see here the extreme moves, and you can kind of see how the gold silver ratio here, and this is going back to 2007, right? So you can see right here. Let's see if I can blow. There you go. So this is 2007. So were you able to predict the down moves of the 2008? No, you can't because it's again it lags. But it shows um relative what's the word I'm looking a relationship between the two of the SPY and the gold silver ratio. And it's the magnitude of each on both sides is fairly similar. Whereas, as I said earlier, the VIX is way more extreme, which is kind of why I think people question it. But this is just my own opinion. If I was to use global risk, not US centric risk, global risk, I would use only the gold silver ratio because it's pretty accurate. And you can see here, and it's predicting a little bit right here on when things started to turn around. So you can see here it peaked here up to November '08. Okay. And it started to decline. But yet, as we start to move in right here in the draw the lowest point of the SPY, you're already starting to see it come down. So that right there in itself would say, okay, this is the peak, and this is only on a monthly view. So you can imagine if you do this daily, hourly, 4 hour view, you can already see as a forward indicator somewhat that we've already bottomed out of the process and we are close to bottoming out. So if you started loading up here, maybe here, just before you hit the bottom, and you can see that big drop there, that's the time to load in because the global risk is declining, and you can see that in the price and the return and performance of the SPY. Right here is where it flatlines. That's most likely the bottom point of this crisis. So you can see here as this starts, and this is now again the SPY. You can see here it's starting to kind of go flatline, but you can see here that the risk is already hinting there's a decline. And this is what the professionals are doing. The insiders, the smart money, they already know that there's going to be a risk coming. And they're using this, and this is the classic way of looking at the markets. You can already consider that this decline right here is hinting that the professional money's starting to get out. Okay, the smart money's starting to get out on this little rally here. And this is going back in 2010. So they're starting to get out, but they're using from this point out as more capital comes in because of the dumb money, retail investors, they're using that capital to use as liquidity to get out of these positions, right? So if you continue here, right here, again, this is monthly view, right here, you're already seeing that there's going to be a big upswing. And what happens? The market does have a massive upswing and it continues. So you can use this view on your measurement if you're going to load up on the US markets and probably the global markets and any market throughout the world. But you can see here it's kind of gone into that random walk, we'll call it, but there's still performance here. And you can see here that the risk goes up on the gold silver right here, gold silver ratio. And we're still looking pretty good because there's no extreme moves. There's a slight one right here. So you can still continue to possibly load up as the markets move up. And you can see because the markets start to move up, what's happening here is the gold silver ratio is telling you there's also some risk happening in the markets. Then it goes flat again. And again, we see right here, risk is coming down. So the risk is going up. You can still load up, but the risk now has come down because it still continues to move up. Okay, so I could go through that all in all. Let's see what happens before the virus came along. So you can see right here, um, everything's going flat in 2020. We can't predict when this virus is going to hit. But right here, you can see it just spikes and the markets come down. And then right here is your entry point to go in the market. Because why? Now you got your confirmation that the market risk has come down and it's continuing to come down to about here. Then it goes back up. And that's where we are, I believe. Well, this from this point forward, the global risk moves up. And you can see it correlates exactly on the price moves. And that's in 2022. So as the global risk moves up, that's the gold silver ratio. You can see you just don't move in the market, right? And then all of a sudden, in that month, we get a big decline in the gold silver ratio. But we're not seeing that here yet. This is your low point of the crisis. And then guess what? Markets moved all the way up. But look right here. We're starting to see it come down. It did elevate, and we're back into this random walk theory. So on a monthly view, the gold silver ratio can be very, very helpful. Okay, that's a monthly view there. So if I go to the 4 hour just to see where it's at on the let's say last 3 months, okay, you can see here, even though the prices are going up, the gold silver ratio is still relatively flat. So it tells you on a higher level, higher time frame level, that it's still bouncing around. It's not moving up. So we're still okay on that level. Once it starts to either spike or whatnot, then we know we can be in trouble. So um, there's the overall view of the market with that. So that's what I would use as your metric versus volatility. So practical strategies for VIX instruments, really, I mean, people are going to still trade on that. Quicker VIX recovery can be leveraged to reduce the length of a drawdown. So that's only if you want to trade VIX on those extreme moves. I wouldn't do it. Some people will because they have the ability to. And then look at the SPX movements, time to market. Um, is the opposite of what most traders do. And that's more of a contrarian view of the market. So if it works for this guy, that's great. But anyways, let's go back to the markets here. I want to show you what I've been seeing lately. Um, so I'm going to now move into the last 3 months. We are going to look at the daily view. Let me just see here. I'm going to move it to daily. Okay. So you can see here, everything looks okay. I mean, we're in this random walk here. But if I was to load up as an example, XAU USD gold and US dollar, um, you could see gold has spiked and now gone into this random walk or plateau or flat line here because the markets are moving up. Gold doesn't move up as well. But this is the problem with gold. Gold is supposed to be contrarian or have an indirect relationship with the performance of gold. That's why people kind of question that. Why is that when gold should be moving in the opposite direction of the markets? The usual answer is because of the manipulation on the trading desks of major banks manipulating the price of gold. We'll just leave it at that. Both in the markets, could also be, other central banks are buying up gold. It could be anything. Okay. But again, you can see here, let me just get rid of our friend here. I'm sorry, this the SPY. Let me pull up this XAU USD. Okay. Okay, so you can see right here where things get distorted. Actually, that's 2019. Let's see if we go back. So generally, yeah, you could see the inverse relationship going back to 2011. Okay, so you can see you have a performance here in the SPY. Gold has gone down, and as SPY somewhat declined. Oh, sorry, that's the gold. Right. Let me start again. So right here's the performance of. This is confusing. Okay, so right now we've got here gold in US dollar has declined, and that should be typical of the SPY moving up. So that kind of works in 2013 all the way. But now, as things start to come around 2016, we should still be seeing gold decline into 2016, 2017, as you can see here between 2012 and 2016. But look what happens, it flatlines. And then all of a sudden it starts to perform. This is now 2020. So under major extreme moves with the virus, the SPY drops back, but then gold starts to move up. But in this period between 2018 and here in 2019, both gold and SPY move up together. This is where it's starting to show. Well, back in 2016, it started to show things were breaking down that relationship. And this is really, really critical to understand that. Where now we're getting into 2019, now we're starting to see both gold and SPY move up together, which should not be happening. So you can see gold started to move up on that decline in the SPY, which was all fine. And then we start to see somewhat of a decline in gold as the markets move up. We could see gold decline farther down, but now they move together. That's how distorted the markets are right now. So you cannot use gold as your indicator as showing an inverse relationship between gold and SPY. You got to remember that we now have BlackRock, Vanguard, State Street, and other asset management companies. These are firms that are well into 10 trillion, $7 trillion money managers. Do you not stop to think that they can manipulate the price of gold? Yeah, they can. And they can also manipulate the price of Bitcoin as well. So this is so critical to make sure you understand that the traditional inverse relationship between gold and SPY is somewhat broken down as I've shown up to 2016. Okay, so what can we do about it? Well, I've already shown you the real ones that you can use just using something like TradingView. So this is how you are able to retain wealth by watching the markets to ensure that You don't take the losses as you can. Um, and one of the better indicators for that is gold silver, as I showed the gold silver ratio. Now, let me show you what's really going on in the markets now on the traditional gold and inverse of performance of the SPY. This is really important now. So if we focus only on the last year, okay, one day. Now I'm going to show you the other ones that were traditionally used, and I'm kind of going on longer here than I would normally, and focusing outside of programming and coding. But this is important to understand because this impacts your coding as well. Because if you don't understand the high level of this, whatever you build in your algorithms and your auto trading, it won't matter because everything's going to break down, which we are clearly in that environment of breaking down. So one of the ways I measure bonds and any major future is through CFD. It's not the smartest way, but it's a poor man's way to looking at the futures market. So if I was to look at, let's say, a 2-year bond, okay, this is again on Awanda. This is why I use Awanda. Um, and let me get rid of the SPY here. Trading. Oh, this one right here. Okay, so what I want to show now is traditionally this 2-year note bond is kind of volatile. Okay, this should not be happening in the markets. These are supposed to be very flat, very, very low variance. And you can see here we've got quite a jump here as well. Here on July 24th, sorry, July 3rd. That's a big jump. That's probably due to the unemployment. But when you look at the volatility, it's kind of crazy. Also, when you look at, let's say going back, I don't know, we'll take a monthly view now. Okay, let's go back to the monthly. There we go. Okay, so if you compare that to, let's say if I pull up another, I don't know if I can do this. Uh, I'll do a US 30-year. That'd probably be a good one to compare. So now we have the long and short-term bonds. Okay. So already you can see, and this would make sense where you have more uh, volatility in the 30-year versus the 2-year. You can see here already that the performance is over a 2-month, and this is going back to the beginning of May, I believe. What day are we looking at here? May 24th. So you can see here we are up 4.8% versus 0.65% on the 2-year versus the 30-year because of the government spending in the US. It's been, like I said, drunken sailors. But if I go to okay, sorry, that's a minute view. So we want a monthly view. So let me pull up the monthly view. Doesn't look like it does that. Let's do a weekly view. There we go. So you can see here how crazy the 30-year is. Now, this should not be happening um, at all. This is going back to 2014 and 2015. But if you go back prior, you can see how it's much more stable, that relationship between, and we're going back to here in 2003. So you could see here the difference between a 2-year and the 30 years. So the 2-year note is this one, very short, very stable in price in the variance over since 2003. Whereas the 30-year has been going crazy since 2010. Much more higher, well, it can be higher performing if you want to look at it, but easily with these drawdowns, that's crazy. That should not be happening at all between the the 2-year note and the 30-year note. How do I know? Look at all the way up to here, to 2008, when things went crazy, started printing money like nuts. And one way I always measure, and I tell people, just go to Google, look up US real time debt clock. This is serious stuff, man. This is why you're starting to see what, like we're at 34 trillion, and they just print what, 1 trillion every 90 days, I believe. I was, I could go on and on about that at the US debt clock. But coming back to this should not be happening. The 30 years should not be so far away or highly dispersed away from the 2-year note as along here. Okay. And even in the crisis, the great financial crisis, it was still fairly tight, that spread between the 2-year and the 30-year. But you can see that spread has just gone too much. And now it's gone negative. And look what's happening is that the 30-year is, or the return has dropped uh, more than the 2-year. This is when you start breaking down things. This is why you're starting to see the volatility in a lot of things. For example, let me pull up another. So, just as an example, if I was to show you the Australian US dollar right here, this is now just simple forex. You can see how volatile the price is. Okay, and that's pretty volatile. You can't trade that. Let me get rid of this other one here. But if I do a comparison, I think what the catalyst will be right here is the Japanese yen, right here. So you can see here the Japanese yen since 2024, or better yet, let me go back at least 5 years. You can see here the yen has really taken off. Okay, and when you factor in the debt level of Japan, which is pretty extreme, this is going to be a catalyst because the government of Japan and the Bank of Japan trying to prevent this rise in the or the weak well, the rise for the USD Japanese yen, or the weakness of the Japanese yen. They're trying to intervene. They tried here, tried here, they tried here, and it fails. Every time they intervene, it has less impact. So this is the natural path of the yen, and it weakens. So at some point, the yen will, something has to happen to it, as long along with the Japanese economy, because the Japanese economy is very wealthy with, car manufacturing, electronics. But when you have the likes of China coming along that are pretty well eaten into their lunch, something's going to happen to Japan. I don't know what, but it will. And this is the future direction of a lot of Western countries that have high debt levels like this. So, again, why am I covering this for algo trading? Because if your algo trading is breaking down, like here, or I'm sorry, like here, when this is what you should have in your typical relationship, if you're trying to trade, like I said, the spread between the 2-year and the 30-year on the treasury, and then all of a sudden it goes crazy, it's because of debt. It's because of what the government's spending, where I could go on about it, but that's why your algo trading is breaking down. It's nothing to do with your typical standard metrics that you're using. So coming back to the original here, um, here, yeah, right here. This is important to know because he's using VIX. I've just shown you VIX has gone crazy from the traditional sense, along with the treasury has gone crazy. I've also shown you that the relationship between gold and stocks are not the same as they were. You have to look for trends. And again, that's why if you use a tool like TradingView, that you can see that if you know what you're looking for. But the traditional sense of the global economy, US specific or not, is broken down. And it's broken down over a lot of years. And the problem here is when people are relying on central news like Bloomberg, CNBC, and like, they're just basically either highly incompetent or they're lying through their teeth. because now we're at a point where you can't rely on the news in the market. You cannot rely on your professional advisor because they're not going to see this themselves, but you can definitely see it in the charts. And that it's the data that creates the charts that don't lie. It just you can't hide it. But the Federal Reserve will go out of their way to make things look great when they're not. And again, it's the charts using tools like TradingView that make the difference. And if you don't understand these relationships, it does have a huge impact on your algorithmic trading. And if you're using a traditional trying to roll your own solution or using a platform, you're not going to see this kind of relationship. You will not have easy access to the data like you can with TradingView. If you do not, as I keep saying it, if you can't understand these type of broken down relationships, two things will happen to you. You'll either become I hate saying it, failed algo trader, and a general trader as well, which means you're losing money and you don't know why. I've just shown you three reasons on why how the markets should be working up until I don't know 15 years ago, let's say, and you were to take a standard economics course back then. These were the relationships that have always been in play, but we've never had large asset managers, like I said, the BlackRocks, the Vanguards that are manipulating gold price and gold, the trading desks that are manipulating the gold price. We never had that before, and we've never had the debt levels that we have now, where the central bankers, namely the Fed, just don't care because they go into their modern money theory and thinking they don't care about debt, and it clearly has a huge impact on your trading performance overall. And they feel that doing these kind of investments and raising debt is in the name of long-term investment. Clearly, things are not working as they say. So this is why you need to kind of like follow along with what I'm doing, you know. And again, yeah, I might be pitching something here, but if you go under the learn at quantlabsnet.com, you can learn stuff and how to use a tool like TradingView to really economically save yourself. And as I always say, it's not my money. And beyond that, what happens to people's money, I don't really care because it's just a matter of time when it'll be too late for them to do anything, especially if you're with a professional uh, financial advisor, because they don't see it either. And they'll just tell you to stay in the market while everywhere else is burning uh, around them. And that's pretty well it. I just want to show you that. And this is why we're seeing volatility. And going back to this article, VIX, I wouldn't even look at anymore. I would look at gold silver ratio as a solution and to really understand what's going on in the treasury market, what's really going on with the relation between gold and the stock markets. Because if you don't, you're going to get wiped out. And it'll be even too late when you lose a job and you got the AI thing going against you, blah, 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 blah. It's going to be tough. And it's better to know this, understand it, and tools like TradingView can help you out. Other than that, thanks for watching.